Welcome back. Earlier today, the non-farm payrolls were reported to have risen 187,000 in July. That was below the expectation of 200,000. June's increase of 209 was also revised lower to 185. The unemployment rate did fall to 3.5 from 3.6%. Average hourly earnings remained at 4.4, greater than the expected 4.2. Labor force participation rate stood unchanged for several months now at 62.6. We're going to take a little bit of a different approach with the non-farm payroll and other employment numbers. We're typically talking about these numbers in the following fashion. For example, today we can see 187,000. That's every new job. According to the survey, the number of new jobs that were created over the prior month. But what I don't think others talk about is the year over year. I think this is a very interesting way to look at these numbers because there is a seasonality. There are more jobs that are created during certain times of the year. So we compare this June to last June, and we can see the rate of change. And what we see here, and these percentages reflect very simply the change from this month, current month, to last year's same month. And what we see is a decline overall. This is around a little over 60%. Now, the number itself doesn't matter so much, but it is interesting to see on a year over year basis. You look at the prior chart, okay, it doesn't look that bad. But then when you take into consideration the year over year comparison, we see that except for January of 2023, really the entire gamut of 2022 through present day, we've seen basically slower non-farm payroll, or not slower, but lower non-farm payroll numbers. That on a year over year basis, we're seeing a slowdown in the non-farm payroll numbers. This is a standard unemployment rate, which is at 3.5% versus falling from the prior 3.6%. Okay, that's great. The blue line, by the way, is the S&P 500. So if you look at this chart, we say, well, obviously the unemployment rate spiked when we got up to May of 2020. That was as a result, of course, of the COVID crisis and everything going on that time. And since then, we've seen a steady decline in the unemployment rate. Okay, this chart looks good on the surface. This is what all the other, news agencies and, whatever it may be, this is how they report the number, 3.5%. This is the unemployment rate on a year over year basis, comparing this June to last June, this July to last July. It's actually July we're talking about here. And we can see, well, okay, this is on a year over year basis. It's unchanged this month, meaning last July, it looks like it was exactly the same or maybe just a hair higher. What we see at the bottom over here is that we saw a negative number. Now, this is the unemployment rates, and negative numbers are actually a good thing. We want to see it go from 3.6 to 3.5. What we were looking at in the prior year, 2021, is a decrease. So May of 2021 compared to May of 2020, the unemployment rate dropped. Now, that's logical because 2020 was an awful year. Okay, so exclude 2021, but you look at 2022 through present day and we see a continuous increase. Even just take 2023, we see an increase. And actually, this month, I stand corrected. Maybe it's a little hard to see, but the current month is actually a little bit of a tick higher, meaning that this month, on a year over year basis, actually shows the first positive number that we've seen since 2021. Now, positive number is a bad thing. It means that this July, we actually have a little bit of a higher unemployment rate than we did last July. And that marks the first increase in the unemployment rate. Remember, the prior chart showed us a steady, move to the downside. It does not show on a year over year basis. We're actually at a little bit of a higher point during the same time of the year, July to July. This is this little tick higher that we're talking about right here. Now, unemployment rate on a year over year basis, this shows us a zoomed in view. Let's exclude 2020, 2019, the COVID crisis. And this is exactly what we're talking about. On a year over year basis, we saw 40% decline. Now, it's 40%, meaning 3.7% down to 3.5, or whatever the numbers were. That's the 40% decline. But what we're noticing now is the current month. This is what we're talking about. It's the first uptick. It's the first increase on a year over year basis of the unemployment rate. This is average hourly earnings. And this is the standard number that we all talk about. The red line's the S&P 500. And you look at this, you say, wow, this is great. This goes back to 2015. And all we see is this number going up. Average hourly earnings of all employees trending higher. What could be bad about this? But compare it on a year over year basis. It's interesting to see the difference. The average hourly earnings, they did increase. We see 4%, but that's not as good as what we saw in 2022. Now, 2022, January compared to January 2021, okay, that's fine. But, that was not 2020, meaning that why are we not at the levels that we saw even in 2022? The average hourly earnings, the increase is not as good as it was even last year. And that's some area of concern. Also, compare this to the red line, the S&P 500. The stock market's moving higher, and usually, I mean, take a look at this correlation over here. As the stock market, the S&P 500, late 2021, 22, this is moving out higher as averagely our earnings goes up, and then both lines kind of go down together. S&P 500 declines as the average hourly earnings goes down, but the stock market's going back up. How come the earnings aren't? There's a disconnect. This is a disconnect we've identified in many, many different charts and many, many different economic numbers. There is a disconnect between the stock market and the economics behind it. This is the labor force participation rate in black. This is shows us the percentage of the people in the country that are measured that are in the labor force. The blue line is the S&P 500. Strong correlation here too, right? We see the blue line goes up as these histogram bars go up as well. Okay, that's a good chart. On a year-over-year basis, though, the red line in this case is the S&P 500, and this is after obviously the COVID crash. The labor force participation rate is increasing higher than it's been, in several months, but really not even as good as it was late 21, early 2022. It does look better than some of the other charts, but it's still not as good. You would expect with the stock market approaching recent swing highs, why does the labor force participation rate not look the same way? This is the unemployment rate state average. It's different than the federal unemployment rate, 3.5% we talk about. We just very simply take the average of all 50 states and their individual unemployment rates. The white line is the S&P 500, and we see the average among all those state unemployment rates is declining, and that is good news. These lines represent the actual individual employment rates among all the different states going back to March of 2021. Now, the individual lines aren't as important, but I think what we can take away from this is as follows. Notice that when we had very strong stock markets, 21, 22, we saw a very narrow spread between the highest and the lowest. The highest, I believe, maybe that's Nevada. Well, excluding that line, we have a very tight contraction over here between the different unemployment rates. And that shows us that all the states, I think, are kind of reacting to the same economics in a very similar manner. North Dakota's economy is a lot different than New York, but it looks like overall most of the states are kind of, moving in the same direction, experiencing the same economics. I think that what's important to note is that when we start to see a larger divergence, do we have a larger divergence? It kind of looks like most recently there are a couple more lines are drifting away from the pack, and maybe and they're drifting higher. Unemployment rates will go up. That's not a good thing. And maybe that's telling us that if the economics are deteriorating, it's obviously going to affect some states earlier, sooner than others. Is that an early sign? It's left to be said. Now, this is very interesting. What we're looking at here are the probabilities of the federal funds rate. This went back to May. We spoke about this in the past. The chart on the left-hand side very simply reflects, or the numbers on the left-hand side reflect what we see in terms of the charts. Let's take the chart because it's easier to read. The red line represents the odds. And this, remember, was coming into the July meeting where the Federal Reserve raised interest rates again. The red line shows us the probability that the interest rates, the Federal Reserve interest rates, will be in the 5 to 5.25 range. Early, or I'd say mid-May, it was at 81%, but then that dropped down to 21%. The green line is the odds that the Federal Reserve will have interest rates at 5.25 to 5.5, meaning that they'll go up. That was at 19% and that rose to 52%. What happened at this crossover on May 24th when the green line went up and the red line went down? What happened here? We can see that 5 to 5.25 was at 24% on May 24th. It jumped to 43 and then continued to jump up to 81, 62, etc. Or I should say, I'm reading this the wrong way. On May 23rd, it was at 58%, and then it dropped to 43, then 24, then to 21, and eventually to zero. During the same period of time, the 5.25 to 5.5 was at 37% on May 23rd, 45% May 24th, 50%, and then up. This date coincides with the release of the Federal Reserve meeting minutes. You see, after they have the interest rate decision, a few weeks later, they release the minutes. And the minutes give us a lot more details about the Federal Reserve and what they're really looking at in the economy. And analysts can dive into this text and try to discern what that means. Well, what was in that text was significant enough to move the market, move the Federal Reserve, federal funds futures contracts, which is what this measures. And that eventually led to the Federal Reserve raising interest rates from 5 and 5.25 to 5.25, 5.5. They're always in a range, 25 basis point range. So this is what happened in May. Well, fast forward to present day. This is what happened today. 5.25 to 5.5. That's represented by the red line. The blue histogram bars is 550 to 575. Now, what this is doing is measuring the probability of the next Federal Reserve meeting in September. Now, on July 21st, the chance that the Federal Reserve was going to keep interest rates at 5.25 to 5.5, that's where we are now, is at 83%. The 5.5 to 575, meaning they were going to raise it again, that was only at 16%. Well, that stayed pretty steady, 83, 82, 79, 80. What happened today? Non-farm payrolls released. The odds that the Federal Reserve will keep interest rates steady and not increase them in the September meeting jumped from 82 to 87%. The chance that the Federal Reserve would raise interest rates from 5.5 to 575 dropped from 18 to 14. It's actually 13.5. So if you want to look into the number today, unemployment rate fell, the non-farm payrolls came in lower, the prior month, June's NFP was also revised down. What do we take away from this? Well, the federal funds futures contracts indicate there's now a greater chance, not a lot, 5%, but a greater chance the Federal Reserve's not going to raise interest rates. Means the market doesn't like today's number, or at least it means today's number shows the labor market is cooling. And that is, I think, the most important takeaway is the market's reaction to all this. The labor market is cooling, not crashing, but it is cooling down. And we know the Federal Reserve has a 2% inflation target, and they will continue to raise interest rates until inflation, which, by the way, the CPI, what's the last CPI? 3.1%. It's still above 2. They'll bring it down to 2. They'll force it down to 2, unless the labor market starts to really weaken. Well, today it shows that we're weakening a little. What does this mean in the grand scheme of things? I don't know. Also, by the way, going back to May's reports, The S&P 500 took off. If you look at the chart from the day, what was it, May 24th, take a look at the stock market on May 24th and to see what the stock market did between May 24th and present day, that tells us a lot. That's when the expectation of higher interest rates took hold. Today's report shows the opposites. Does that mean that that's going to translate into weak stock prices? Maybe because, the stock market's going to get nervous about a cooling labor market? What do you think? We're going to have to wait for the market to tell us what it thinks, but it's certainly a very interesting turn of events. We hope this has been helpful. We look forward to seeing you back soon.